Hello and welcome to the first ever Signal or Noise Economists Roundtable. Although this is the third season of Livewire's show dedicated to macroeconomics and top-down investing, we have never done a show featuring an all-economist panel. Until today, that is. For this month's show, we have assembled a panel featuring the very best in the business. Mousina, Deputy Chief Economist at AMP and our series regular, is here as you might expect. And joining us this month, how's this for a resume? Luci Ellis, Chief Economist at Westpac and a 30-year veteran of central banking, including 7 years as Chief Economist of the RBA. And Johnathan McMenamin, Senior Economist at Barrenjoey, veteran of firms such as EY and the New South Wales Treasury. Welcome to you all. Thank you for joining me.
Thank you.
Thank you. Should be good. Let's get started with a conversation around stagflation. Just bringing the mood right down. US economic growth recently undershot economists' expectations, just 1.6%. in the first quarter. But inflation, through the Fed's preferred gauge, which is core PCE, has trended downwards generally, but in recent months has hit some bumps in the road, and that's causing some participants to start sounding warning signals. And the chart you are now looking at simply shows these two data points together. But it's not just markets who are concerned over stagflation. News headline mentions of the subject have soared to levels not seen since June 2022. And that chart showing the spike from the Bank of America is now on your screen. So, panel, for the first topic today, is the threat of stagflation in the US a genuine signal for Australian investors, or is it all noise? And Deanna, I'll turn to you. Signal or noise?
I'll say short-term noise. For this current point in the cycle, you really need to see higher unemployment and much lower growth to be concerned about a stagflationary environment. A stagflationary environment would probably be the worst outcome for equities because it would be hard for the central bank to cut rates, but at the same time you would probably have lower earnings growth, so you would see a big fall in share markets. If you had a recession though, you might see an initial large fall, but then shares would probably bounce back on the prospect of rate cuts. But I'm just not seeing any signs that the unemployment rate's going to soar in the US from here. I think it will go a little bit higher, but not much higher, above 4.5%, I'd say. And that's still low relative to history.
Yeah, no, fair enough. Johnathan, do you concur, or are you going to go signal on this one?
It's definitely noise, I think. If you look at where inflation is, if you look at underlying measures of inflation in the US, particularly trim mean measures, there really hasn't been much of any acceleration at the start of the year. It's been in that core measure, but not in the trim mean measures. And so inflation is still present, but it's only a little bit above the Fed's target. And growth is generally pretty good in the US. If you look at it globally, they're sort of the outperformer, and they've got really solid productivity growth relative to other countries around the world. So I think there's a lot to like about the growth outlook in the US compared to some of these other countries, and really the talk about stagflation is probably going to be a short-term one.
That's fair enough. Luci, where do you fall on this, signal or noise?
I'm also on noise, but for different reasons. I think it's really important to remember that inflation is determined by the balance of supply and demand, and domestic demand was actually really strong in the US and remains so. The GDP number might have been a bit weaker than expected, but a lot of that was the bumpy parts of the aggregate. Underlying domestic demand is still really strong, and that clicks into one of my key themes about the strength of the US consumer and just how easy it is to get strong growth when you're running a 6% of GDP deficit.
Let's pick up on that consumer theme, and we'll talk about the chart that you've actually brought along. Of course, one of the biggest reasons for parts of the global economy, the US primarily staying so strong through this period, has been that consumer spending strength. Walk us through the chart you brought along, Luci, and I guess particularly how Australia is so different as well.
Well, the US is an outlier on one side and Australia is an outlier on the other side. In the US, as I mentioned, they're running a 6% of GDP federal deficit at a time when the labour market is very tight, when inflation is still too high and wages growth is really strong. So this is an economy that's very close to overheating, and fiscal policy is adding to that. So it's no wonder that expectations of Fed policy have been pushed out. You contrast that with a number of other countries, particularly in the English-speaking countries, but also the Euro area, where consumption per capita has been soggy. It's not falling drastically, but monetary policy is working by shaping people's incentives to spend versus save. And then you've got Australia, which is an outlier on the other side. And what's going on here is it's not just that we have a really interest-sensitive household sector where we have mostly variable rates and where pass-through to the rest of the economy of the policy rate is stronger, as is widely recognised. But what's less recognised is we also have non-indexed tax brackets, and the increase in the tax take over the past year has actually been greater drag on household income growth than the drag from higher interest rates affecting net interest payments. And so Australia is uniquely being hit on both sides. And so it's no wonder that consumption per capita in Australia has been consistently falling through this period.
Yeah, we're going to talk tax and policy a little later. Thank you for bringing that along. For topic 2, let us bring it back home, and specifically the Australian first quarter inflation print caused a sell-off in markets despite it only being 1/10 of a percentage point higher than what economists were expecting. The chart you are looking at on your screen now is from the ABS. That is the one that all the data crunchers and the journalists look at. Light blue line is headline inflation, and dark blue line is trim mean, or what the RBA looks at most closely. Multiple research houses also used that first quarter inflation print to shift back their forecast for the first rate cut. Some cases the very tail end of this year, some cases even very early next year. So, panel, we're going to begin topic 2, and Johnathan, I'm going to start with you for this one. Was the first quarter inflation print a signal that the RBA's job is about to get tougher, or is it noise because it's just a bump in the road? Signal or noise?
Look, I think I'm going to err on the side of signal here. There is a lot of informational value within that first quarter data, and it does show that there's quite a bit of stickiness still within the Australian inflation basket. We are definitely at that point in the cycle where we think inflation will stabilise around the 3.5% mark for the next 6 months. And in that sticky zone around 3.5%, you're really erring on the side of, does the central bank need a hike, or does the central bank just stay high for longer and start a cutting cycle later? So, we have a call for rate cuts from February next year, but there's still a high probability of a hike this year than there is of cut from our view.
Okay, well, we'll come back to the hike and cut philosophy a little later. I want to pick up on what you said about sticky, though, because that pertains to the chart you've brought along. Tell us why the chart you brought along is so important to you.
Yeah, so we at Barrenjoey have been developing an index which basically looks at the persistence of high inflation in the Australian basket. And what we do is we ask 2 questions. The first question is, which items are driving high inflation at the moment? So we divide the basket into high inflation and ones that are running below their average or around their average rate of inflation. The second question we ask is, of those items, are they ones that traditionally would see deflation? So you can think of things like computer prices or your phone plan, which has traditionally seen deflation. You can think of, and the second category is flexible, so things that move up and down quarter to quarter or day to day, in the example of petrol prices. And the third is things that show continuous persistence and things that traditionally rarely ever deflate. So you can think about construction costs here, or rents, or medical services, education, insurance. There's a broader number of things here. And what this chart shows you is the 3 components of the inflation basket, ones that are rarely seeing deflation, those flexible, and those that traditionally see deflation. And at the moment, almost all of the high inflation that we're seeing in the basket now is being driven entirely by those things that rarely ever see deflation. So we think there's quite a lot of signal in that last print, which highlights to us that you are going to hit that stickiness in inflation. And it's very unlikely that we could see inflation back to the midpoint of the band. And if we do get back to the band, it's likely to be at the top half of that band.
That's why the last mile is always the hardest. Thank you, Johnathan. Luci, signal or noise?
I'm going to err a little bit more on the noise side. If you look at the kinds of parts of the inflation basket that tell you about discretionary demand, that tell you about domestic demand, they're actually not that strong anymore. I think Johnathan mentioned construction costs and rents. We know that the strong population growth that's induced that is rolling over now. So we do expect those to deflate, but it will take a while. I mean, a rate rise is on the table, but we don't think it will come to that.
Okay, all right. Deanna, where do you fall on this, signal or noise?
I'm going to follow Luci and say noise as well. When I think about the medium-term outlook for the economy, still pretty poor growth, 1 to 1.5%. We think the unemployment rate's going to rise. We think wages growth has rolled over. And when we look at our forward-looking indicators of inflation, I have a chart on that a bit later on, it's still pointing to lower inflation. And when you look at the trends in Australia's inflation data in the past few quarters, there has been this tendency for the CPI to come in a bit hotter, then to come in a bit colder, and then for that kind of thing to play out over the course of the last few quarters. So I think in the next quarter we'll actually see a print that's coming in a bit below forecasts.
Okay, well, let's pertain to that then, because you've already alluded to your chart. Long-time viewers of this show may actually recognise this chart, but it does seem appropriate to bring this one again. Tell us again what you see in this chart.
So we built this pipeline indicator, inflation indicator during the pandemic. It was meant to be a forward-looking guide to all those supply chain issues that were going on. So it accounts for things like some commodity prices, shipping container costs that relate to Australia, the Chinese producer price index, which has a good correlation to Australian inflation as well, all the price surveys that we get in our business surveys, both in PMIs and in the NAB business survey. And it's actually been quite a good guide to goods inflation, not so much services, but in the goods sector it has been. And overall, the red line in this chart is the headline inflation data, and the blue line is our pipeline indicator. And you can see that it still has more downside to it in the next 6 months. If you compare that, we have the same one for the US. The US one has flattened out. So I think it'll be harder for the US to see lower inflation in the short term without an increase in the unemployment rate. But for Australia, it's still pointing to lower price growth.
All right, thank you for that. Part of the reason we assembled the panel we did today is not just because it's a powerhouse of big names. Part of the reason we also did, and you may have already heard it already in that little discussion, is because there's a huge divergence in each of the panelists' interest rate views. So with all that in mind, panel, Johnathan, I'm going to start with you again. I'd love for each of you to give us a quick summary of your current view for what the RBA will do next with rates, and a signal, so it can be a data point, it can be a change in language, whatever it may be, and a signal that would change that base view. Johnathan, I'll start with you. Yeah,
so our view, as I said before, is we're looking for a first cut from February next year, and for one cut per quarter following that, to bring it down to more of a neutral rate after that. But in the very near term, we do see there is a higher probability of a hike in the coming couple quarters than there is a probability of a cut. And the reason I say that is because of the stickiness that we're talking about on inflation. What the RBA has painted here is a picture of we need to get inflation back to the band by 2025, right? And because of that timeline that they've set for themselves, there is the risk that inflation could continue to push a little bit above their forecasts. And if there was indeed any signal within that last quarter of data, and you see that follow through in the next quarter of data, then that will push the RBA further towards that direction. We can all see that monetary policy is proving very effective in Australia. Luci talked about it before. The consumer is incredibly weak in Australia, and dwelling investment is turning over. But we're still seeing this persistence within inflation. At the end of the day, the RBA is an inflation targeting central bank, and the labour market is in really good shape. So we think that probability of risks is skewed slightly towards a hike this side of the year.
So, two additional questions then. If you had to put a number on that probability, because that's the kind of person I am, everybody, what percentage would you put on the chances of the RBA hiking again in the very near term? And what signal would change that base case view?
Yeah, look, I think probability of a cut from us would probably be something like 10%, 15% this year. And the probability of a hike this year would be something like 20, 25%. So it is low. Our central case is clearly that we're going to be on hold for the rest of the year. But if you did see a trim mean print of 1% or 1.1% next quarter, then the probability of that increased significantly. That would show you that trim mean has basically printed at 1% every quarter for the last 3 or 4 quarters if you take out the effects of subsidies in Q4. And really there's been no traction on the inflationary front.
There's the number to watch for, everybody, 1%. Luci, tell us about the base case view. I know you've already alluded to it a little bit. And what's the signal that would change the base case view?
Well, at some level, our base case is similar to Johnathan's, but just starting in November and then 1 1/4 thereafter, landing at the end of next year at 3.1, which is probably either neutral or a little below. And the way I think about it, and having been there, what do they need to see to be convinced that they are on the right track? I previously thought that if inflation was coming down as they were hoping, then they'd also want to see wages and productivity, so they wanted the full suite of the first half of 2024 to be convinced, and that takes you to September. But because we've had this inflation surprise, then predicated on the idea that inflation is coming down, and again, domestic demand is very weak, discretionary inflation is very weak, there are aspects of non-administered services inflation that are actually pretty weak, assuming we don't have further upside surprises beyond petrol, then they'll be on track, but then they're just going to need a bit more inflation data. So that takes us to November rather than September, as I previously thought. If you saw ongoing strong inflation, stronger than expected, particularly for service inflation, if you saw an outsized Fair Work Commission decision, which is not what we expect, they're not going to do again this year what they did last year. Inflation is a lot lower. Or if you saw the government surprisingly do things that they're promising not to do in the budget, well then the game changes.
Deanna, let's go through your base case and the signal that would change it.
Well, it was for the start of rate cuts from June. We obviously pushed that back now. So we're the same as Luci at Westpac. We have a start of rate cuts in November. And I'd say that the one key indicator that I would look at, I agree with Johnathan, a 1% increase in the trim mean in the second quarter inflation data, I think would push them to a hike in August. If you look historically, every time the trim mean number has been around 1% over the quarter, it has ultimately led to interest rate rises in most cases. So that's the key indicator that I'm watching.
Okay, last question for this portion, everybody. We talked a little bit about hiking. I know it's not everybody's central case, but I thought this was interesting from Josh Williamson and Farah Syed at Citi, and it does pertain to the timing of a rate hike if the RBA wanted to do it. So here's the quote: while not our base case, either, if the bank wanted to hike, it's got to do it soon, and the sweet spot to do so is the June monetary policy meeting. So, one line or one word answers, everybody. If the RBA feels the need to hike, have they got to go in June or at least as soon as possible? Johnathan.
I think for the RBA, what they really care about is the Q2 CPI. And so the most likely month, if they were to hike this year for us, would be August.
Okay, so August, what do you think, Luci?
I think August as well. The national accounts are not going to be strong, and that's the data flow that they have ahead of the June meeting is none of the things that will give them pause.
Okay, Deanna?
I don't understand why it has to be in June at all, so August would be the month.
Thank you all. For our third topic, we're going to shift things a little bit from the monetary to the fiscal. This week, the federal budget for 24-25 is being tabled in Parliament. Treasurer Jim Chalmers has already flagged that another surplus is within reach. One of the big challenges, of course, at the moment is that post-COVID fiscal spending is marginally higher than pre-COVID average. I think it's 27% versus about 24%, according to KPMG, and you can see that in this chart. And of course, it's already been flagged that this budget will not have any big cash splashes, so to speak, and the government claims that any additional cost of living relief will only add 0.1% to inflation. So, with all that in mind, panel, I've got a little bit of a challenge for you, given I know for a fact you'll all probably be all up well late into Tuesday night passing through papers and writing research reports for clients. What is one signal you are watching out for in the budget? And what is one bit of noise that investors, consumers should overlook? And Luci, I'll turn that to you.
We're also expecting that the year we're in will record a surplus, and we think a third surplus is in reach, depending on what they do in the budget and how some of the parameters turn out. My colleague Pat Bustamante put a note out earlier this week on that. I think the noise that everyone needs to discount is the presumptions around the iron ore price and therefore corporate tax revenue. I think they're probably also quite properly a bit conservative on what they think their funding costs will be. And while I'm not particularly bullish on bond yields, I think there's a lot of conservatism built into our fiscal system, and then they get a pleasant surprise at the end of the year, and that's the game they play in order to keep a lid on spending. In terms of the signal, I'd be interested to see how much of the revenue windfall that they build in that they then go to spend.
Yeah, no, absolutely. Thank you, Luci. Deanna, one signal and one noise. What are you watching for on Tuesday?
The signal would be the change in any policy announcement. So that's how we would think about any potential fiscal stimulus. And what it's worth, some economists this week have been saying an extra $7 billion in government spending is worth one interest rate cut. But I don't really think about it like that because it depends what they're spending the money on. So we would sum up all the spending measures and then think about any stimulus like that. One noise for me would be around some of the net debt measures. A lot of investors sometimes get worried and look into these net debt indicators, but I sort of think it's not really relevant in this point in the cycle for Australia.
Yeah, no, fair enough. Johnathan, one signal, one noise.
Yeah, so I think the noise actually is the forecast for FY24 deficit, FY25 rather, deficit. As Luci mentioned, we think there's a pathway to a surplus in FY25 as well, so a third consecutive surplus. I think people will be focused on, there's this expansion in the budget position. We don't think it's that simple. I think the bit of signal that you can find though is within the budget papers, and this is a bit nerdy and niche, but you can look at the structural component of the budget deficit and the cyclical component of the budget deficit. And I'd be really watching the structural component of the budget deficit, and if that is substantially expanded in FY25, which we don't think it will be, then that's what we'd be focusing on for the RBA. And beyond that, what it means for the future outlook of the budget position beyond 25 is that structural deficit.
That does it for our first ever Economist Roundtable. Can I just say a massive thank you to Luci Ellis at Westpac, to Johnathan McMenamin at Barrenjoey, and of course to Deanna Mousina of AMP. Thank you as always for being here, all of you. Thank you so much for an enlightening and a fantastic discussion. Our next show is the annual show dedicated to cross-asset income investing. If you've enjoyed the program, please subscribe to our YouTube channel and to both the Livewire and Market Index websites. And we'll see you in a month for the Income Investing Show. Thanks for joining us.